What's up, YouTube? I'm William Bitter, and this is my channel, Money Thoughts.
Money Thoughts.
On this channel, I do a lot of talking about saving and investing, and today we're going to talk about approximately 25 tax loopholes that could potentially change your life. I think taxes are like one of the biggest expenses in our entire lives, so learning these things and understanding them from a very young age could change the trajectory of your financial independence for the rest of your life. I truly believe that. If you've ever wondered why rich people have businesses, invest in stocks, and invest in real estate, it's because these three channels allow you to avoid taxes on large portions of your income. So basically the system is made in a way that it actually incentivizes people to invest in real estate, to invest in the stock market, and to start businesses. And it's because these activities stimulate the economy, create larger GDP growth for the long term. And so the government is happy to give people tax breaks for growing the economy. So not only will you be taking advantage of these huge tax loopholes, but you'll actually be helping the economy overall. So that's pretty cool. The great news is that it's never been easier for the average person to take advantage of all of these tax incentives. With technology, it's never been easier to start a business, it's never been easier to invest in stocks, and it's never been easier to invest in real estate, thanks to the rapid acceleration of technology. So, I think we live in a very exciting time. So let's dive right into it. So starting your own business or side hustle is one of the best channels for avoiding taxes. So tax loophole number one, if you have your own business or side hustle, you are able to write off business expenses against that income. So that means that if I have a dog walking business, I can buy this computer tax-free. All right, so basically if I make $1,200 with my dog walking business, but I buy this computer for $1,200, then I can write that off as an expense and I pay zero taxes on that $1,200 income because I use it all and put it back into my business in the form of this computer. So, as opposed to if I had a normal job, I would probably have to earn about $2,000 at that normal job and then pay like $800 in taxes. And then with the leftover money, I'd have to spend that $1,200 on my computer. So that's the difference between, having your own side hustle and business and expensing things versus spending after-tax income. So basically, the name of the game when you have your own business is try to expense everything. Everything you could possibly think could have anything to do with your business, you want to expense it. And I could honestly make a whole video on business expenses, but the truth is, if someone tries to evade taxes by not reporting income, they could go to jail. But if you accidentally write off something that shouldn't be a business expense, the worst case scenario is they're going to penalize you with a small little fine, like a small interest that you'll have to pay on that money that you didn't pay taxes on, and then you'll just have to pay the taxes. Tax tip number two, if you have formed a business entity like an LLC, you can avoid Social Security and Medicare on 2/3 of your income. Basically, you pay corporate taxes on those 2/3, and then usually the rule of thumb is that you have to pay yourself 1/3 of your business income as employment income. All right, so tax tip number three is kind of like tax tip number one. You can, instead of paying taxes on your business income, you can actually just reinvest that money into your business. So whatever your business is doing, let's say you have a dog walking business, and you can just order a bunch of leashes because that is going to add value to your business and you can expense all of it. Whatever, if you just have some way that you can channel your business income to increase the value of your business. Let's say your business is building car factories and you made $100 million last year, or this year you made $100 million. All you got to do is spend $100 million on another car factory, and all of a sudden your business is twice as valuable and you don't have to pay any taxes on that $100 million profit because you've reinvested it into your business. Yeah, I know that's not a good example for the average Joe, but I'm just trying to think. Yeah, essentially, you just got to use your imagination a little bit. whatever your business is, if you can reinvest your profits to increase the value of your business, you can kind of put off those taxes on your income. And then eventually, if you just keep reinvesting your income into your own business, the value of your business will grow. You kept reinvesting in your own business, you never paid taxes, and all of a sudden your business is worth $1 million. Now you go to sell your business because it has value. The only taxes you have to pay on that $1 million gain, because it's a long-term capital gain, you've owned your business over a year, probably if it's grown to be worth $1 million, then you can pay long-term capital gains, which for most people is about 15%. If you sell your business for more than $500,000, you're going to pay like 20% capital gains tax, which is still probably less taxes than you would pay if you were paying on your business profits the whole time instead of reinvesting in the value of your business. But if you sell your business for less than that, like $400,000, you're only paying 15% long-term capital gains, which is pretty good. Tax loophole number 4 is if you have a business, and let's say the business is making $200,000 a year, which is a lot. You're probably going to pay pretty high taxes if you're earning $200,000 a year. But what you can do is you can actually hire your brother, your friend. You can basically hire a couple people that you're very close with, and you can pay them each. Let's say you hire 3 people and you pay them each $50,000 each, and you pay yourself $50,000. Now all of a sudden, everyone's only paying taxes on a $50,000 tax bracket, which is probably going to be a lot less taxes than someone that would file an income of $200,000. So like if you have a family business, for example, you can pay your kid and your spouse. Yeah, that's actually maybe a better example. So like if you have a family business and you have a brother and a spouse and a kid, and you have $200,000 of income, instead of just taking that income on your own and probably spending $100,000 in taxes, you can actually pay your spouse, your brother, and your kid, like I think they have to be a certain age or something, but you can basically pay them each $50,000, pay yourself $50,000, and now all of a sudden, each person is only paying like $10,000 each, so that's like a total tax liability of like maybe $50,000 instead of paying a total tax liability of like $100,000. So spreading your income around your family is an advantage that you can use when you have your own business to basically lower your tax bracket on your income. So that's a pretty cool strategy. Obviously you want to do this, legitimately. Double check all this stuff with an accountant, but these are just ideas to kind of kick around. Tax loophole number 5, if you use your car for any income-related activities, business-related activities, you can write off about 56 cents a mile as depreciation against your car. So that's pretty cool. Like I have a rental property in Colorado and I plan on driving out there, and that's like, I don't know, a couple thousand miles or 1,500 miles that I'll get to write 56 cents off per mile. So I'm really going to be able to write off like a good $700 tax write-off just for driving out to my rental property out there, which will save me a couple $100 in taxes, which, is probably less than I'll spend on charging my car. It is obviously a lot less than I'll spend because I actually have free supercharging for the year. So I'm actually going to make money by driving across the country to go to my rental property in Colorado. So that's kind of cool. Tax loophole number 6, if you have your own business, you can write off your healthcare expenses. So if you're paying your own health insurance premiums, if you get a doctor's note to go get a chiropractor or a massage, or as long as it's a health related, I believe you should be able to write off all of that on your taxes. So as opposed to paying out of pocket, this is a pretty great thing to take advantage of as well. So that just about covers most of the loopholes that I'm aware of regarding owning your own business or having your own side hustle. However, there's probably so many other things that I missed and that I'm maybe not even thinking about or that I'm just not aware of. So definitely, if you guys have any tax avoiding tips or tax loopholes, please comment down below and share with the rest of us, because I'm always all ears trying to learn how to avoid taxes and save and invest money. So, all right, so the next channel for avoiding taxes is investing in stocks. Tip number 7. So a lot of people I know have been getting into the Robinhood investing game, and a lot of people are kind of buying when it's going up and selling when it's going down, and some people I guess are doing pretty well doing that. I'm a buy and hold long-term kind of investor, stocks that I really believe in for the long run. But and that's fine if you're making money day trading, but I just want people to understand that when you buy a stock for $100, let's say you buy $100 worth of stock and you sell it for $110, and you do that like a day later, a month later, you're actually going to have to pay taxes on that at your highest income bracket. So if you've got a job and your highest tax bracket is like 40%, then yeah, that $10 gain might look more like a $6 gain. And if you keep doing this over and over again, that $4 tax on every $10 you're gaining kind of adds up pretty quickly. So a lot of people don't realize this, but then what happens is at the end of the year, you're going to have this big tax bill for your all your trades that you made throughout the year. So anyway, I think so. Yeah, tax tip number 7 is to buy and hold your stock investments for at least a year, so you can actually pay long-term capital gains tax, which is about 15% for most people, unless you've got like over $450,000 of capital gains. Then you got to pay like 20%, which is still cheaper than most income tax brackets. So, all right, so that's number 7. Tax tip number 8. If you invest in a stock and you basically just hold on to it forever, you can actually avoid paying taxes for as long as you avoid selling it. Let's say your stock grows by 10% every year, you can actually just compound that gain every year for like 30 years, so it could grow pretty substantially without ever having to pay any taxes on it until the day you need money or you need to sell it for some reason. Then you're going to pay a 15% tax on that gain, so like basically you can just put off paying taxes for a very long time by just not selling your stocks. So that's tax tip number 8. The longer you wait to sell your stocks, the longer your stocks can grow without you paying taxes on it, and you just keep putting off the taxes. Tax tip number 9 for investing in stocks. This is something I wish I fully understood when I was 18. I wish someone really sat down and like made sure I understood this, but opening up a Roth IRA is probably one of the greatest tax avoiding strategies ever. I mean, if you're investing in the stock market and you don't have a Roth, and I don't know, it just seems crazy to me. So basically, all right, so what can you do with a Roth IRA? So basically, a Roth IRA, you can, for most people, there's some income limitations. If you make a lot, you can't contribute a certain amount. But for most people, they can contribute about $6,000 to their Roth IRA every year. So how it works is, if you're investing in Robinhood anyway, that's probably money that you've already earned, paid taxes on, and then you're investing in Robinhood, right? But if you open up a Roth IRA, you can basically have a self-directed Roth IRA, which is basically like you can make trades just like on Robinhood. There's other platforms for this. But a Roth IRA account, self-directed Roth IRA account, you can actually put the money in there. Let's say you put $6,000 and it can grow to $10,000, and you don't have to pay taxes on those gains. However, you can't touch the gains until you're 59 and a half, I think. But you can always take out the $6,000 contribution whenever you want without paying any penalties. Obviously, double check all this with your accountant, but you can take out your contribution at any time, but your gains have to stay in there until you're 59 and a half. But this is a great tool because you're basically able to day trade without paying those taxes. You can buy Tesla, it goes up, and then you sell it, and you buy Coinbase, and then it goes up and you sell it, and you can move things around into different stocks without having to pay taxes, because the way it works is you've already paid taxes on this contribution and you don't have to pay taxes on your gains ever, as long as you don't take out your gains before you're 59 and a half. So that's pretty incredible, because that means, if you invest, if your Roth IRA goes from, if you put $6,000 in there a year for 10 years, $60,000, and then it like 40x's over your lifetime, I mean, we're talking like hundreds of thousands of dollars of a retirement account that when you go to take it out later, you just don't have to pay any taxes on it, which, yeah. So, I mean, I think it's a pretty amazing tool for avoiding taxes. I just started contributing to my Roth IRA last year, and this year I've already maxed it out, but I plan on contributing $6,000 every year. And even now, like, I'm holding like this huge holding of Tesla, and I'm like, God, if I sell this, I have to pay 15% tax. I actually don't plan on selling Tesla in a long time, but for example, I'm holding a bunch of other stocks that I kind of want to sell to buy Tesla, but then I'm like, oh man, I gotta, like, if I sell this, then I have to pay capital gains tax on it, and then if I buy Tesla and it goes up, then that's more capital gains tax that I have to pay again later. I'm like, why didn't I, if I had contributed to a Roth from a young age, most of my, more of my money at least would be in this Roth, and it would be growing tax-free instead of having to worry about these 15% tax charges on hundreds of thousands of dollars of gains, which I didn't expect to happen so early on in my life, but they did. But we're talking like $20, $30, $40,000 worth of taxes that I could have probably avoided if I just started putting money into a Roth sooner. So anyway, live and learn, right? And all you can do is go forward. But my message to you guys is to open up a Roth IRA and start contributing as much as possible, as soon as possible. It's funny because there was an older gentleman a long time ago at some job who was ranting and raving about the Roth IRA, and I was like, oh, I know everything, and like, I was like, it's so long until I'm 59, and like, what? I don't want my money to be tied up. But I didn't even realize that you could actually take out your contributions at any time, just not the gains. If I would have kind of really understood that, I think I would have maybe done it. I thought I understood what a Roth was, but I didn't know you could kind of take back your contributions, essentially meaning you have nothing to lose, for putting your money into a Roth IRA. So, all right, tax tip number 10. All right, so if you have an exceptionally large income and you don't plan on making a large income in the future, a traditional IRA is a huge benefit, obviously. So basically, if you're making like $1 million a year working for some company, and that at a certain date you're not going to be able to handle this job anymore, you're just going to want to retire, you can basically like you're paying such high taxes on like the latter half of your income that whatever money you can contribute to a traditional IRA is going to be a huge amount of tax savings. And if you're not going to make anywhere near that much when you retire, investing in a traditional Roth IRA is definitely a good idea. I kind of feel like I might make more money when I'm older. I'm just optimistic about my future, and I just think I'm never going to retire. But there's certain jobs that it's like, if you're working super hard and you're going to leave, and I don't know, a traditional IRA definitely makes sense for certain people that are, especially if you're in a high tax bracket. So definitely look into that as well if you're making a lot of money. Oh, this is one of my favorite ones. Oh yeah. Number 11, the long-term capital gains tax rate if you make under $40,400 for the year is 0. So like, I mean, I don't know why it took me so long to figure this out, but this is just insane to me. I mean, when I learned this, I was like, seriously, what the like, how have I not known this my entire life? And this is kind of when the gears really started turning. I'm like, wait a second, I'm pretty sure it wouldn't be that hard for me to retire at a very young age. And the reason is, all right, $40,000 a year, I'm pretty sure I could live off that, especially if I didn't have to pay taxes. This was kind of my thinking that went on in my head. I was like, all right, if I had like $400,000 saved and invested in the stock market, and the stock market returned on average about 10%. It's a little bit less than that, especially if you account for inflation and stuff. It's like 7-8%, but still like a nominal amount of about 10% a year. So if you have $400,000 invested and you're getting $40,000 a year from your investments, you could realize $40,000 a year in capital gains, use that to live on, and pay $0 on that $40,000 capital gain as long as you don't have any other income. And I was like, this is mind-blowing. I was like, why doesn't everyone do that? I mean, that's basically, you would have to work a job making like at least $65,000 a year to have the same income as someone, after taxes, that ends up being about $40,000. You'd have to have that amount of income and work to have the same income as someone that just saved $400,000 and is living off their investments for the rest of their life and not doing anything. So that really incentivized me to start saving and investing as soon as possible. And the great thing is, even if you have a side hustle and that side hustle provided you with like $24,000 a year of income, and you just managed to like shift all your expenses into the business expense category, you could basically earn like $24,000 a year. Most of it's expenses. If you love your job and you're doing what you love, then, like let's say you're making videos of snowboarding and you write off your snowboard and your lift ticket or something, I don't know, and you post that on YouTube, like whatever if you make your business what you love doing, then you can easily shift your business expenses into your you can easily shift your personal expenses into your business expenses. And that means you could have like a $24,000 a year side hustle that you basically write off just about everything, so your income is very close to zero. And then if you had $400,000 of savings, you could basically get $40,000 in capital gains every year, tax-free. So now all of a sudden you've got like $65,000 or $64,000 of income that you're literally paying zero taxes on. You're doing what you love, and $65,000 a year paying no tax is essentially the same thing as having a job that pays you like $100,000 a year, and then you pay like 35% in taxes, right? And there you go. You're working a job that you hate, making $100,000 a year, which sounds great, but your take-home pay is $65,000 a year, and you're not really doing what you love, and you're too tired to go snowboarding, versus this other lifestyle that I've kind of imagined of living off of capital gains and having a side hustle that I love, that I can shift most of my personal expenses into business expenses, legally, of course, with the consultation of my accountant. Number 12 is tax harvesting. This one's pretty simple, and basically you are able to deduct up to $4,000 in losses for your stock investments every year. So that means if you have a losing stock, let's just say it's GameStop, and let's say you lost $4,000 in GameStop and you sold it, but you invested in all these other things, and let's say you have $4,000 worth of gains from other stocks, but you have this $4,000 loss, you can actually claim that loss against your gains. And I'm pretty sure if you don't have any stock market gains, you can actually claim that $4,000 loss against your income. So that means if you're making $50,000 a year, you can take that $4,000 tax, $4,000 capital loss against your income. Double check that, but I'm almost positive that's what my accountant told me. And you can basically avoid $4,000 of income tax using your tax harvesting. So definitely look into that one, because that will save you another, potentially save you another $1,000 in taxes every year. So, I mean, all these little things really add up, Okay, so now we're going to move on to another channel of tax loopholes is in real estate. So investing in real estate and rental properties. So number 13 is you can invest in real estate in a state or municipality or an area where the local and state taxes are low, property taxes. So you can actually avoid a ton of taxes by just investing in real estate where there is low property tax. Pretty simple, right? But a lot of people don't. They kind of have their heart set on a certain area, and they don't kind of factor in like, wow, like a huge part of my mortgage is like taxes, and that takes away a lot from your earnings from a rental property or any property. All right, so one of the really obvious ones that I learned when I got my real estate salesperson license a long time ago, I didn't do much with it. Number 14 is avoiding $250,000 of capital gains tax, $500,000 if you're married. So what I learned is if you buy a house for, let's just say $500,000, and then it actually appreciates in value, and now all of a sudden it's worth $750,000, when you go to sell it, as long as you've lived in that house at least 2 years out of the most recent 5 years, you can actually completely ignore capital gains taxes on $250,000 of capital gains. This is a real estate thing. And if you're married, you can actually ignore $500,000 of capital gains. That means if your house was worth $500,000 and now it's worth $1 million, if you've lived in it most recent two out of the most recent 5 years, you can avoid taxes on $500,000 of capital gains. So number 15, you can actually write off depreciation of your house, kind of like that car write-off per mile. You can depreciate it over 27 and a half years. So basically, the way this works, it comes out to about it's like 3.5% a year, basically, of depreciation that you can write off for your home. So basically, technically, you're not allowed to depreciate your land. So if there's different rules. You could talk to your accountant, but basically, let's say your home is worth $100,000 just for simplicity's sake, or let's say it's worth $110,000 for simplicity's sake. Let's say the land is only worth $10,000. You can depreciate that $100,000 value of your home. 3.5% of that is $3,500 a year that you can depreciate. Basically, you're taking a tax deduction off your home. Even though your home is most likely appreciating, you're still able to write off this depreciation, which is this just takes off taxes off your bill every year. The only thing is to consider is when you go to sell your house for capital gains, when you go to sell your house and you're trying to avoid that $250,000 of capital gains tax, you then have to kind of add back all that depreciation you took off. So for example, if you have a $100,000 home and you've written off $50,000 of depreciation, but it's actually appreciated by another $50,000 to $150,000, then you actually, technically, because you depreciated it $50,000 and it appreciated $50,000, there's actually a $100,000 capital gain that you will need to realize. But luckily, this is a small house. You can actually, as long as you've lived in it, as long as you've lived in it 2 out of the most recent 5 years, that $100,000 capital gain tax, that $100,000 in capital gains is totally tax-free, up to $250,000. So you just, at a certain point, so you can see, so that's kind of where the depreciation and so it's just important to understand that the depreciation will add to your kind of tax basis when you're calculating your capital gains in the future. So important to realize, but still being able to write off this depreciation every year is pretty incredible. Number 16. Rental income allows you to write off minor home improvements, as well as utilities and mortgage interest. This is pretty obvious. Most people kind of know this already. Obviously, if you're in real estate, you probably know everything I'm telling you if you're investing in real estate, hopefully. But if you haven't gotten into it, these are things to get you excited about it. You're basically writing off most of the stuff besides your equity gain every month. I mean, you're writing off, you have your rental income and you get to write off improvements, minor, like, let's say you paint or you clean the carpet or put new carpet in, and mortgage interest and utilities. So it's a lot of write-offs, just like owning a business. Like, you can write off business expenses that have to do with your rental property. So, all right, number 17 is the 1031 exchange rule, which basically, if you ever need to or want to sell your rental property, and you, for some reason, it appreciated a ton, you haven't lived in it, or you haven't lived in it in the most recent two out of the most recent 5 years, then you can basically do a 1031 exchange. I've never done this, but I hear all about it, and you can actually exchange. You can basically, you sell that house and you buy another similar rental property somewhere else, and you don't pay capital gains taxes. Instead, it kind of gets carried over into your next rental property. So you're just pushing the taxes off into the future. Maybe you'll never pay it because you'll never sell, right? But this might allow you to buy a larger rental property. Like, maybe you had a single family home and now you bought a duplex. Or you should look a little bit further into the 1031 exchange, but it's a great way to kind of push off capital gains taxes on your rental properties. This is like something that I'm not going to think about for a long time, but I guess if I ever have kids, tax tip number 19 is there's this thing called like stepped up taxation. Basically, if you really get into real estate and you have like 10 rental properties and they've all appreciated by like hundreds of thousands of dollars, so that means you've got like millions of dollars of appreciation that you would owe taxes if you started selling all your rental properties. But you have kids and you want them to like inherit your legacy or something, and you obviously want to avoid taxes, right? So there's this thing called stepped up taxation, where if you die, your kids can actually inherit all your properties, and they don't have to pay any taxes on all your capital gains that you owed. The taxes die with you. And then your kids all of a sudden own all these properties and they don't owe any taxes on the capital gains, and then they continue to appreciate. And then, I don't know, maybe they'll do the same thing with their kids, or maybe they'll sell all of them and do something, I don't know, start the next Tesla company or something. Maybe that's what I would do. Okay, so that's number 19. Obviously, these kind of things I would really like look deeply into, because talking about saving taxes by dying, then you really got to talk to a professional, because that's some deep right? Okay, but nevertheless, it's relevant, because if you're able to push off taxes, I mean, all those properties were probably supplying, you with a solid income to live out your life, and then you're able to leave something incredible for your kids. I kind of don't really believe in doing that, because I think I want to teach my kids to really work hard for it, or whatever, learn how to create that on their own. But I really don't think inheriting a bunch of money is actually healthy for your own. Anyway, I'm not going to get into that. Totally different topic. All right, so tax tip. All right, so that kind of covers the real estate bracket. Now I'm going to go into like the other tax loopholes that I know about. Tax tip number 19. Move to a state with lower income tax. Yeah, so pretty obvious, but in some cases, if you move from like one of the highest income tax states to one of the lowest, you could probably save like 9% taxes on your income. And if you're like a high income earner and your job is remote, you don't have to be where you are for your job. Potentially you could, if you're making like $200,000 a year, if you're like high income, high income is different for everyone, but like the average New Yorker, a lot of New Yorkers make a ton of money, like 200, 300,000. So like you could basically move to another state and probably save like 9% on income tax, which of $300,000 income is like $27,000 a year, which is essentially enough to buy a house in probably said state. like, I don't know, like Texas or Nevada or something. So like a lot of the time it's like simply moving to another state could give you a free house, however you want to think about it. But yeah, just I think with things going more remotely, I think of like Starlink in the future and like people having internet access from everywhere, and being able to do things remotely. I think there's going to be a lot of people moving around to lower income, lower tax states. We already see that's happening, but I think it's going to continue to happen. I don't know where that's going to leave New York, honestly, but we'll see. All right, so that's number 19. Number 20, this is for all the travelers out there that have like coding jobs. Foreign earned income exclusion. So basically, if you live outside of the US for at least 330 full days out of the year, you can exclude just over $100,000 in income as long as that income was earned abroad. So basically, if you work for like a foreign entity and you live outside of the US for like most of the year, you can actually just avoid US taxes altogether. That being said, you might be taxed by like some other entity. I don't know. You got to look more into that, but I know I have like friends that they like can't come home for too long because they don't want to pay taxes. Because like if they come home for like an extra week out of the year, then all of a sudden they're going to be stuck with like an extra, $20,000, $30,000 or $40,000 in taxes, and they're like, I can't come for that long. Come visit me in Mexico, or so that's kind of interesting. So foreign earned income exclusion. I was kind of looking at that as like, wait, can I just be a YouTuber in the Philippines and not pay taxes? But then I think, because YouTube is based in the US, I don't think I'm able to get away with that. You have to like work for a foreign entity. But yeah, look into it. It's a pretty interesting one. All right, tax tip number 21. I thought this was kind of interesting, is like if you plan years of your life where you don't earn income, there's actually certain activities around that. I'm trying to think. So like, for example, if you have planning certain years where you don't earn any income can allow you to avoid taxes in certain ways, like for example, taking a year off and realizing $40,000 worth of capital gains. Like we talked about, there's a 0% tax rate on capital gains as long as it's under 40,000 and you don't have any other income for the year. So I think that is a pretty, it's nice to align those things with taking a year off. It's like, well, I'm taking a year off and I'm avoiding 15% capital gains tax on these capital gains. So like for certain, anyway, I'm just thinking of ways to justify taking a year off, right? I guess maybe that's what's happening. Also, I don't think this is quite tax related, but like, and I would look into this further because I'm not even sure if this works, but when I was in school, I was a ward of the state because I grew up in foster care. So like, technically my legal guardians were the government, so I could put that my parents had zero income because legally I guess there was no income. So I was able to apply for FAFSA and get a full ride through financial aid through college. But I always wondered, I'm like, a lot of these parents, they like save up for their kids to go to college, but I'm like, can't you just not, like, I would just wonder if the parents just took a few years off of work, like force themselves to take a few years off of work, then their kid, like, if they take a few years off of work while their kid is applying and going to college, then their kid could probably get a full ride going to college and report that their parents are taking, that they're not making any money. Meanwhile, the parents can have a long 4-year vacation. Kid can go to school for, I just think that's just an interesting way. I was like, wait, like, instead of working so hard to save up for a kid to go to college, you could just take a 4-year vacation, right? Sounds a lot better to me. But I think there's certain like asset exclusions. If you have a certain amount of assets, your kid might not be eligible for financial aid. So definitely look into that further. But I think it's worth checking out just in case. I'll probably look further into it when I've got kids and they're ready to go to college. But I think that's a ways away from now. All right, so that's tax tip number 21. Number 22. Oh yeah, this is a lot of us get taxed indirectly through inflation. So basically, to avoid indirect taxation of inflation, you just don't want to hold cash. Like if I put $10,000 under my mattress, like cash, and just let it sit there for like 10 years, every year it's going to depreciate by like 2%, which is like the average inflation rate of inflation. So, like over time, that money's just, even though it's still $10,000 in 10 years is going to be worth less than it is now. And so just holding on to cash, even in your bank account that's paying you like 0.001%, if they're paying you anything less than 2%, then your money is actually depreciating in that bank account. That's why I think it's super important to invest in things that don't get inflated that don't get depreciated in value through inflation, like investing in stocks and real estate and business. Number 23. Stay up to date on tax credits and sales taxes in your local municipalities. So basically, you always want to be Googling, like, are there tax incentives or tax credits for certain things? Like, I bought my Tesla and I registered in Colorado because I have an Airbnb out there, and I got a $4,000 tax credit because it's an electric vehicle. I got a Tesla. And then I installed insulation on my roof, and I think I got like a $250 tax credit. Not only will that insulation save me on heating over the next 10 years, but also I got a $250 tax rebate. So just or for example, if you bought an electric vehicle in New Jersey right now, you don't have to pay sales tax on it, which is just all these little, or there's certain states that don't have sales tax, or there's certain states that certain things are, there's honestly infinite amounts of these little loopholes. So just definitely stay up to date on those tax incentives and loopholes. It's really good to have an accountant because you can bounce all these ideas off of them. All right, so number 24 is it's better to underpay tax than to overpay tax. So basically when you're signing up for a job, and I can't remember, I haven't done this in so long, but you put a 0 or a 1 and they're like, oh, this one is if you want to pay more taxes up front and you get a refund, or this one is you pay less taxes up front and you might owe taxes at the end of the year. A lot of people are like, I don't want to owe taxes at the end of the year. But the truth is, it's actually better to owe taxes at the end of the year, because if you are overpaying taxes and they give you a refund, then that refund is basically money that you should have been able to save and invest over the course of that year and have a return on over that year. There's different ways of looking at it. You essentially gave the government an interest-free loan of whatever your refund was for the year, whereas it would have been a better use of that capital to be invested, and you missed out on whatever gains you could have invested that refunded. So it's actually better to underpay as long as there's no penalties for underpaying. So anyway, talk to your accountant, but just look into it. It's good to look into this stuff. All right, so number 25 is you can actually write off donations. I forgot how much you can write off, but I think it's $500 worth of donations to Goodwill. So if I want to donate something, there's a whole checklist you can print off from Goodwill. If you're, a lot of us, we just throw stuff in the trash, but if you take a lot of your old stuff and donate it at Goodwill and you check off a bunch of boxes, I got shoes and a shirt and a table, whatever, they will actually give you, they'll like sign off on this receipt, and you'll actually be able to put that in your tax folder. And at the end of the year, you give your accountant that, and they'll be like, oh, you donated $300 worth of stuff. Good job. And here's a $300 tax write-off for the end of the year. You know, there's another one. It's not a tax tip, but I'm just going to throw it out here because I don't know. But, you know, basically all the money you're spending every year, if you are not getting like at least 2% cash back from your credit card, if you're spending money with a credit card, you're not getting like 2% cash back, then that's just a huge a wasted opportunity. I mean, there's all these credit cards that give at least, like, I know multiple credit cards that are giving 2% cash back right now. And there are some that give more for certain categories. For me, that's kind of a headache to keep track of, and I don't like being manipulated into certain categories, even if it'll save me $50, because I just don't have the headspace for all that. But 2% cash back on everything, I mean, if you're spending, I mean, even if you're just spending like $10,000 a day, sorry, $10,000 a year on your credit card, you know, 2% of that is like $200 a year, and just free money just for making sure you have the right credit card. You know, $200 a year is not nothing. And if you're spending $20,000, $30,000, $40,000, then, you know, we're talking $400, $600, $800 a year in cash back from your credit card. So definitely make sure you have a good credit card and you're getting those points, getting that cash back. I don't know. That's all of the tax loopholes that I could think of. I really think a lot of them we could take advantage of, and just being aware of them and almost steering our retirement plans around these tax loopholes sometimes makes sense, because they're huge. So yeah, if you guys like this content, if you gained anything from this video, please make sure to like, subscribe, and hit the notification bell. All these little things help the YouTube algorithm spread this information around YouTube. And also, like, if there's anything that you think I missed or think I said wrong or whatever, you know, misrepresented, please make sure to comment down below. I love to hear your guys' thoughts, and I try to read all the comments except for on the one 80 square foot apartment video that has like thousands of comments that I have not been able to keep up with. I try to read all the comments on the other videos. So I don't know, I really appreciate you guys, and I hope you guys get something out of these tax loopholes. For me, I'm passionate about this stuff because this is extra money in my pocket to save and invest and create financial freedom for the future. So, oh yeah, still have green hair. I might get a haircut for the summer. Anyway, thanks for tuning in, guys. Peace out. Save and invest your money.